The U.S. office market shifted into high gear during Q3 2014, posting one of its best quarters of activity since 2005. On the heels of strong leasing by tech, financial services, and energy companies, demand for office space reached its highest level in 7 years, with more than 16 million square feet of positive net absorption recorded during the quarter. As a result, the U.S. vacancy rate fell 40 basis points, the sharpest quarter-over-quarter drop we've seen since 2005. The national average asking rate edged up, posting its 13th straight quarter of growth, although it's still around 3% below its pre-recession peak. And around 5 million square feet of new multi-tenant supply was added in Q3, which, while still below the national long-term average, was the second highest quarterly tally in the last 4 years. On the capital markets front, investor appetite for office assets remains strong, with investment sales volume topping $30 billion for the quarter, up 22% from last year. And moreover, cap rates continue to compress, with the national office cap rate falling to 6.7%, near its all-time low. The main factor driving the stronger performance of the U.S. office market right now is healthier job growth. Office-using employment is now growing at its fastest pace since 2006. And as companies hire more employees, they're ramping up their leasing activity to house them. This is particularly noteworthy given all the recent adoption of workplace trends and the theme of doing more with less. Another factor propping up demand is the growing supply-demand imbalance. New supply levels are still near historical lows, so occupiers have to tap the dwindling supply of existing vacant space. This is giving landlords more leverage in lease negotiations, resulting in a more challenging and more expensive environment for occupiers. As such, they are more willing to ink leases now to secure space, propping up demand. Most markets in the U.S. are squarely in recovery or expansion mode. All told, about 2/3 of the markets tracked by CBRE Research recorded declines in vacancy during Q3. Like last quarter, the strongest improvements were seen in secondary markets, with Wilmington, San Jose, and Nashville posting the largest quarter-over-quarter decreases in vacancy. Gateway markets also fared well during the quarter. Of the 10 largest markets nationwide, only Washington, D.C. saw an increase in vacancy during Q3. We expect vacancy rates to keep falling and rents to keep rising for the remainder of 2014 and throughout 2015. As demand for office space will continue to easily outpace new supply. While the pace of office completions will remain fairly low by historical standards, it will start to pick up in the coming quarters. Around 81 million square feet of new office space is currently being built nationwide, a 10% increase from the previous quarter. Investment activity should remain robust, as there is a huge pool of debt and equity capital from both foreign and domestic sources targeting U.S. commercial real estate. However, investors are paying close attention to several macroeconomic trends, including interest rate increases, the strengthening U.S. dollar, and slowing global growth, which could affect U.S. investment trends in 2015.